First of all, thanks for doing this for a third time now in the series. As a whole, it's been really successful, positive feedback. But with that said, we're going to talk a little bit about some annuities and the value of that. So it's all yours.
Thanks, Brian. So, greetings, everybody. What we're going to do today, I want to touch at least briefly on what we touched on before, because many of you were not on the first call, which talked about the market and the fact that we are in a stock market environment today that is historically high, historically risky, and that's the challenge. Okay, so we're going to touch briefly on the challenge before we talk a little bit about the potential solution, which in today's call is going to be a deeper dive into very specific types of annuities. Not the bad ones. There are some bad ones out there, but some annuities that are potentially very elegant solutions for retirees to solve for the challenges as retirees of wanting to continue to beat inflation on our money, okay, consistently beat inflation, but take losses off the table and potentially catastrophic losses off the table. So again, this is my background. Very quickly, former analyst. I covered the chemical sector and the energy sector, and basically did risk reward analysis, analyzing these companies at a deep level and writing research reports on them, forecasting their earnings, and recommending which companies to own and which companies to avoid. So understanding the cost benefit and the risk reward that was embedded in the stock market and in the price of individual stocks. That's my background. It's the exact same type of analysis I think people need to be doing when they're thinking about their retirement. If you're retired or near retirement, it's kind of an opening statement. If you're at retirement or within 5 years of retirement, you need to have made a shift in your mindset from a wealth creation mode to a wealth preservation mode. And that's not easy to do. Mentally, that's difficult to do. We've been in a wealth creation mode our entire adult lives, and now suddenly we need to be thinking more in terms of conservation and being smart, putting more emphasis on avoiding risk than on capturing bigger gains. It's hard mentally to make that transition. It's even harder to actually execute it, meaning to reallocate our assets in a way that accomplishes that. So we're gonna talk about how we do that in a very substantive, valuable way. Before we do that, I want to make a very important and legitimate disclaimer, which is we're not here to advise anybody on investments, on legal advice, tax advice, none of that. That's not what we're here to do. Whether or not an annuity makes any sense for any one of you, it's a very specific thing to you and your unique circumstances. So that's a one-on-one conversation to determine if an annuity might make any sense at all for you. Questions of suitability and appropriateness come into the equation with those types of one-on-one conversations. So please keep that in mind. So again, how do we execute that transition? Let's talk a little bit about the types of annuities that we are talking about here. You'll hear the expression zero is your hero. What does that mean? If you peg the growth in your annuity to the stock market directly or something related to the stock market, and that index that you've pegged your growth to declines, no matter how much it declines, you just don't get growth that year. You don't give back any of your principal. You never record a loss. And each year, you record your gains. If there are gains to be had, you get them that year. You lock it in. And then the gain and the underlying principal is protected going forward. So you can't lose money. Okay? You cannot lose money. You cannot give back your gains, which are locked in every single year, can be set up to lock in your gains every single year. Hidden fees. this is a very important question. You hear a lot of talk about hidden fees and annuities. If I put my money into a growth annuity, for instance, and I do a 7-year growth annuity, and the market goes to hell in a handbasket, every single year the market goes down. So each year, when I'm saying, how much growth did I get? The answer is zero because the index went down. That's a scenario where the US has defaulted on its debt, or the US dollar has collapsed, or World War III has crazy historic things. But assume that's happened. I recorded no growth for every single year of the life of my annuity. At the end of the annuity, the carrier will write you back a check for 100% of what you put in. Okay, so where are the hidden fees in that? There are no hidden fees in that. That's the type of annuity that we're talking about. Okay, lifetime income. A lifetime income is when we surrender a certain amount of money. We give up control over that money in exchange for a contractual guarantee of X dollars for the rest of our lives, or the rest of my life and my spouse's life, if you want to do a joint income annuity. Some of them are way better than others. Okay, but that's what a lifetime income annuity looks like. Okay, and those can be very powerful if you're looking at your fixed income as a retiree. If you're looking at how much are we saving every month? How much are we bringing in excess of our costs? If that's kind of a razor thin margin or not a very large margin, and with inflation over time, we're a little worried that that might become a negative number, we need another lifetime income stream. Okay, and a lifetime income annuity, converting a 401k, for instance, into a lifetime income annuity can make a lot of sense. And we'll talk about that as well. So these types of annuities constitute elegant solutions for retirees in any type of environment. But if we happen to be in an environment where the stock market is at high levels, in this case, historically high levels, our incremental returns off of very high market values should be expected to be well below historic averages. And in fact, we should be anticipating a big correction. If we're in that type of environment, this type of annuity becomes incredibly valuable as part of our solution, as part of our asset allocation solution. So let's just quickly review what we covered before on the market. You've all heard of Warren Buffett. Warren Buffett developed what's come to be known as the Buffett indicator or the Buffett ratio. He once made the statement, and I'm paraphrasing, if I take the stock market value and divide it by the economy's value, that is the single most telling, useful measure of whether or not the stock market is expensive, overvalued, i.e. risky and dangerous, or significantly undervalued, really cheap, and a great time to be getting into the market, or somewhere in between, fairly valued. The Buffett indicator. Okay, again, the economy generates the cash, right? Any asset that I'm thinking about buying, an asset, I need to be asking myself, what kind of cash flow can this asset generate for me? How long do I believe it can generate it for me? And now I need to account for the time of collecting those future cash flows. I need to discount those cash flows back to today's dollars. So I discount it back and I say, is this, can I pay less than that number, or am I paying more than that number? So the underlying earnings, in this case, the economy, tells us something about the index itself, whether it's valuable or not. So that's all Buffett was saying. We are today at the highest level in the history of the Buffett indicator, and we need nearly an 80% correction in the stock market, the S&P 500 today, in order to get back on this trend line. It's crazy overvalued and implies a big correction, years of recovery time, significant losses we don't get back for a long period of time, and I'm going to cover that. If we look at another valuation metric, the Shiller ratio, okay, the S&P 500 divided by full cycle earnings of the S&P 500, it's at over 40 right now. Only time it's ever been higher was before the tech bubble, and we had a 75% drop in the NASDAQ from here and a 60% drop in the S&P 500. We've never been higher. Okay, again, Do you know what you need to get back on the long-term average for the Shiller PE ratio? About a 70% drop in the stock market. So very close to what the Buffett indicator is telling us. We're at historic highs in the stock market, folks. Let's look at what's happened when we've had historic highs in the Shiller PE ratio and none higher than where we are today, okay, except for the tech bubble. If we go back to January of '07, okay, that was the financial crisis. We saw a 22% drop in our money from that Shiller PE ratio high. 5 years later, I had lost 22% of my money. That's not adjusting for inflation. If I adjust for inflation, I lost even more than 22%. 10 years later, I was up 3%. Adjusting for inflation, that means I lost a lot of money. 10 years after the fact. The tech bubble, peak Shiller PE ratio, dropped almost 40% over 5 years. I was down 40% before accounting for inflation. 10 years, I was down 53%. 1966 inflation crisis, high inflation, the Fed started to tighten. I lost 30% of my money when the Shiller PE ratio hit that peak in 1966. 5 years later, I was down 30%. 10 years later, I was down 53%. You can see what some of these other crises did. Again, all I looked at was when the Shiller PE ratio got to historically high levels, well above normal ranges, and none of them were anything near where we are today. When I looked at those points in time, I said, what happened to my money 5 years later? And what happened to my money 10 years later? These are crazy numbers if I'm a retiree. I don't have 5 to 10 years. I can't be down 39, 40, 50% in the next 5 years, down similar levels, 10 years. I don't have that kind of time to recover. And if we quickly review some of the other crises, actual crises that cause big declines, peak to trough, and I adjust for inflation and ask myself, how many years did it take before I was just back to where I was before the correction started to happen? How long did it take just to break even, get back to where I was? 19 years, 30 years, 24 years, 16 years, 7 years, even 7 years. Do I have that? If I'm retiring, could I afford to lose a bunch of money and not just get back to where I was for 7 years or more? For most of us, that answer is no. So we are at levels in the stock market where if you're not discounting a 50, 60% correction, you're really not paying very close attention to basic measures of valuation. Okay, if I asked you, could I afford a 20 to a 50% decline on my nest egg if I knew it was going to take at least 10 years to get it back? All of us would say no, I couldn't have. That would radically change my retirement plan. But if we look at most people's portfolios, if you own a 401k, if you own a retirement account, if you own REITs, pretty much every asset class other than cash and precious metals, you're being told by financial advisors you're diversified. Overwhelmingly, when you're being told you're diversified, that's based on looking at how those asset classes that you're in correlate with each other in normal times. The correlations are low. That would allow a financial advisor to tell you this is diversified. This doesn't move with the stock market. But the only question you need to be answering or should be answering is what's the correlation when the market's under stress? When the market's collapsing, do REITs hold up? No, they don't. They don't. Nothing holds up except cash and precious metals. They auto-correlate during the panic. Okay, everybody's running to cash. So you thought you were diversified. You thought you had some downside protection by being diversified. And you don't learn until you actually needed that diversification that you weren't diversified at all. I can show you that data in spades if you'd like to see it. Okay, so let's look at an example. How can an annuity solve for this? Again, I said it's an elegant solution. This is a lifetime income annuity. Okay, so let's start with that. If I was a 62-year-old, this is Delaware Life. Okay, their True Path lifetime income product, one of my favorite lifetime income products. If you're a 62-year-old male and you put in $500,000 into a lifetime income annuity, in this case, he wanted to start his lifetime income in 9 years. You don't have to wait 9 years. You could do it in as little as a year, but every year you wait, you get a larger amount of lifetime income. And when you look at how much larger, with all of that known up front, it's effectively guaranteed returns. The longer I wait, I'm getting 8, 9, 10% guaranteed growth in my nest egg. That's how much your lifetime income increases by waiting that extra year. So $500,000 for a 62-year-old male. 1 year later, that individual would get $40,432 paid for the rest of their life. If he waited 2 years, he'd get $44,000. That's a 10% increase in my lifetime income. That's a pretty good return if I'm able to wait that extra year. If I wait 7 years, I'm up to $65,000. Look at the compounded returns from 40,000 to 65,000 over a 6-year period. Those are really attractive compounded returns, especially in the context of our starting point being one of the most expensive stock markets in history. So again, risk reward, cost benefit. This is a wonderful product. This last column is another feature of this product. If I become chronically ill, and let's face it, as we get older, the risk of chronic illness where I need help with any 2 of the 6 daily tasks of living, you can Google those, they're standard definition, bathing yourself, dressing yourself, etc. If I need help with any 2 of those 6, I get an income doubler for 5 years. So I get twice as much lifetime income for those 5 years. And in year 6, I go back to the lifetime income that I already had. That's a valuable rider that's included. So that's a lifetime income annuity. Again, in certain circumstances, that can be a really valuable thing. How many lifetime income streams do you have that you cannot outlive? Cannot outlive. Other than Social Security, most of us don't have any lifetime income annuity streams. So this is one solution. What about a growth annuity? What about an annuity where I don't want to give up my 500,000. Lifetime income, I'm giving it up in exchange for that lifetime income. Now, if I died in 2 years in the lifetime income, most of my account value back with the carrier is still intact, and that would be the death benefit that went to my loved ones. So you're not giving it up in that sense. But you're giving up control of that money by entering into a lifetime income annuity. In a growth annuity, okay, fixed equity indexed annuity. Again, I can't lose any money. Guaranteed I cannot lose any money. Now, carrier risk is another question. Okay, I could lose money. What if the carrier went bankrupt? And the state insurance for annuity providers and the industry insurance for annuity providers ended up not covering my annuity. Very unusual, by the way, for an A-rated carrier. I don't know if I can think of one. I can think of a B-rated bank that had annuities that people bought into that went bankrupt. Imagine that happening. We don't even traffic in B-rated companies. A B rating doesn't scream risk, by the way. It doesn't. That's considered good. But I wouldn't touch that with my lifetime savings, my nest egg. I wouldn't go near anything less than an investment grade carrier. That's all we traffic in. That's what security benefit is. That's the name of this carrier. So what if I wanted to say, I don't want to lose any money. I want to take that off the table. Well, if I peg my growth with security benefit in a 7-year or a 10-year fixed equity indexed annuity, I'm locking up my money for either that 7-year period or that 10-year period. Okay, if I just change my mind, I want to take it out, they'd hit me with a surrender charge. So we don't want that to happen. So we don't want to put money into a fixed equity index annuity that we're not pretty confident we'll be able to keep in there. If I got really sick, I'd be able to take it out, by the way, sooner than the end of that 7 or 10-year period. But But so 7-year, 10-year, I can peg my growth in this case to what's called the UBS Multi-Asset Inflation Awareness Index. And I can peg my growth to lock it in every year, or I could lock it in every other year. They'll give me, sorry about the noise in the background. They'll give me up to 200% of whatever that index does if I do the 1 year lock in my growth, and they'll give me 285% of it if I do 2 years. So what I did in this particular example is I broke half of it up into the 1 year and half of it into the 2 year because I didn't want the client to go 2 full years without getting some growth locked in and protected. So we layered it. So now he's got some growth locking in every single year. 11.39%. That's the most, that's the average return over the last 10 years. And that happens to coincide with the worst 10 years when we back test over the last 20 years, the worst 10 years out of that last 20 years, pegging your growth to that index, it averaged over 11%. Now, that doesn't mean that's what it's going to do over the next 10 years. And I actually like the S&P 500 as my growth, my crediting option. You've got 30 different things you can peg your growth to. If you did the S&P 500, and every year, what did the S&P 500 do? Well, I just said we're worried about a 50 to 60% drop in the S&P 500, but that doesn't hurt me. I get up to 9.25% from the S&P 500. So if it's up to 9.25, that's what I get. If it's more than that, I get more than that. How many 10, 11, 15, 20% returns in the S&P 500 do you think we're going to get given the historically high levels of the S&P 500 that I discussed earlier? So I really like that I could lock in the S&P 500 and get up to 9.25%. That's not what's in this illustration. Actually, this UBS Multi-Asset Inflation Awareness Index illustrates extremely well. So the 500,000, based on the last 10 years performance, pegged to the UBS Multi-Asset Inflation Awareness Index, that 500,000 by the end of the 10 years is worth 1,464,000. That's what it's worth based on that historic performance. That's more than protecting yourself against inflation. Okay, that's substantial growth. And what I would say to everybody who's considering a growth annuity is I'm doing it based on the risk reward. I'm expecting 6 to 8%. Even that's not guaranteed, but that's what I think I'm going to get. And I'm comfortable that that's what I'm likely to get. I could get double digit. Okay, my upside is in double digits. My downside is I don't get any growth, but I'm guaranteed against losses. That's my downside. I can't lose money. If I'm a retiree in one of the most expensive markets in history, that's a really compelling risk reward scenario. So it's okay if some of this was a little bit confusing, okay? But if it sounds interesting, okay, I get 6 to 8% likely. I can't lose my money. And 11+%. Think of that as my upside. I can do that in this type of a product. That sounds interesting to you? And I think it should. What we've done is back to that shift from wealth creation to wealth preservation mode. This accomplishes that. Okay, the idea that I've got zero correlation with market declines, that's incredibly difficult to get other than cash, which doesn't generate decent returns over time. Don't even keep up with inflation for the most part. Long-term CD rates are 2%, even though they've been higher in the last couple of years. So I get a zero negative correlation in the years when the stock market goes down, but I get up to 9.25% if the stock market goes up. We've now accomplished what I said is so difficult to accomplish. Diversification is hard. And it's misleading because you're led to believe you've got diversification. I've got protection if the stock market goes down because 70%, 80% of my money is in something other than the stock market. And then we have a 50% drop in the stock market, and I see that all of those other things went down almost 50% as well. I didn't have the diversification. You have that diversification contractually here. So again, risk reward, very compelling, very attractive. So as I said at the outset, a fixed equity indexed annuity or a lifetime income annuity with a investment grade credit rated carrier. Okay, so we minimize the carrier risk. It's as close to zero as it can be. These are some of the safest, most conservative companies that you're ever going to find. These insurance companies, these A-rated insurance companies. The right type of annuity with the right carrier is an elegant retirement solution in any market. But in a market where the stock market is at historically high levels, and there's no question about that. That's not a controversial statement by me. You can demonstrate that a million different ways. In that type of environment, this type of solution, it's off the charts in terms of risk reward. So if you think this is interesting enough to have a one-on-one conversation and discuss it further, to try to figure out if this might be a fit for you. It's not a fit for everybody. Okay, be really clear about that. It's not. Some of us just aren't even suitable for it. We couldn't get it for you if you wanted it. But if you think it's worth having a conversation to see if this might be a part of your retirement solution, a part of it, your retirement needs to be an asset allocation decision. I don't put all my assets in any one thing. If you want to explore that, let us know and we'll set up a conversation, we'll set up a call and see where we go from there. That was my contact information. So with that, Brian, Lee, you guys want to jump in here? Anything that I said you think warrants some clarification or elaboration?
So Jay, I do have a question that was shared, and it's related to required minimum distributions, RMDs.
Yep.
Uh, Basically, are they required on annuities?
If you've got qualified money and we roll it over into an annuity, what's known as a qualified rollover, there's no taxation involved in that. Let me just be clear about that. It does not relieve you from RMDs. RMDs are still in play. Okay. But even if you do a fixed equity index growth annuity, you can withdraw up to 10%, including your gains in the products that we're talking about. Every year, you can withdraw up to 10%. And that's more than adequate to fulfill your RMD obligations, regardless of what you're putting in. So yes, you do still have to comply with the RMDs. But you can do up to 10% withdrawal of that security benefit growth annuity with no penalties whatsoever. So you've got enough liquidity in that type of a product. I had completed the response to how do RMDs play into this. But again, in a nutshell, you still have to comply with the RMD requirements for qualified money. You still have to comply. But this type of fixed equity index annuity allows you up to 10% penalty-free withdrawals every year, which is more than adequate to cover any RMD obligations that you're going to go through. Any other questions?
Uh, Not at this moment. So Jay, one of the things, I've been around as, financial advisor or, that sort of thing historically. Annuities, I'm sure you talked a little bit about this, but some of the negative rap can be, front end loaded and I was probably distracted. You might have talked about, just some of those negatives, and how you try to, overcome that.
So one of the negatives that you really do have to be mindful about is compulsory rider fees. Meaning I have no discretion. That rider's in there and they're charging me for it. They'll often be over 1%. Well, in a lifetime income annuity, all I really care about, how much are you going to pay to me and my spouse for the rest of my life if I put this much money in? I'm not that worried about what's going to happen with my so-called account value. It has no bearing whatsoever going forward on my lifetime income. I've already locked it in. But what it does have a bearing on is, well, if I die before I've received lifetime income for enough years, typically 12, 13 years, that I've gotten 100% of all the money I put in, I've gotten all that back. And every year I continue to live after that, that's just return on investment. But where a rider fee does come into play, and all of those lifetime income products have rider fees, typically 1.15%, that's affecting that account value. Now they're getting a return, but the return on the money that I've put in is very conservative in a lifetime income annuity. And it typically, historically, has roughly covered that rider fee. So my account value is really there to make sure if I only got income for a couple of years or something, there's a lot of account value that goes to my loved ones as the death benefit. It's not like I lose that. And that's where those rider fees come into play. So again, I'm not too worried about it unless I want to look at a lifetime income where I say, I'll take less lifetime income for me and my wife for the sake of potentially preserving the account value longer in case we do die after just a few years. We want more to go to our loved ones. So again, I can give up some lifetime income in order to preserve more account value for longer. It doesn't guarantee that there's going to be anything left for my loved ones anyway. If I live 12, 13 years, it's still going to be gone. So I just gave up some lifetime income for the sake of preserving more for my kids and my grandkids that never came into play. Sorry, I can't stop that once this thing is going. I don't know how loud that is for you guys.
It's fine. It's not a big deal. So Jay, another question, and we talked about this.
I'm sorry, Brian. Let me
Yeah.
finish. On the growth annuity, I did touch on this earlier. This idea of hidden fees. Financial advisors want to manage your money and they want to be collecting fees managing your money. So for that reason, annuities, there are some bad annuities that are justifiably criticized, but annuities more broadly are criticized by these financial advisors. They don't want you doing them. Okay, so the growth annuity that I just showed you with security benefit, this idea of hidden fees, if they're giving me up to 9.25% in the S&P 500, that's all I need to know. If they're going to give me 100% of my money back at the end, if I had no growth in every single year, which means the S&P 500 went down every single year, Armageddon. If you didn't put your money in an annuity or in gold or something, and the stock market goes down every year for 7 to 10 years, you're going to get crushed because of the autocorrelation. No hidden fees in that security benefit. There are no fees. They're not charging you anything. The 9.25 they're offering you is based on their historical performance that they're looking at internally and saying, this is what we think we're going to do. And if we're going to do this, this is what we're willing to give to the client. They got to pay a fee to the agent. Okay, those fees, just so you know, they're like 8%. How that's broken up, to your agent versus maybe somebody your agent works for or whatever, that 8% is not extra that you've got to somehow cover through the growth of the S&P 500. All that's baked in. They're giving you up to 9.25% in the S&P 500. That's your growth. If there's no growth, you don't get any growth, and you get all your money back.
Another question. So we obviously talked about IULs last week and the potential value of that. How would you differentiate when it's appropriate for an IUL versus an annuity?
So an IUL can be used by somebody who's looking to roll over qualified money from a retirement account. It's It's a lot more complicated, but we know how to do it, and we can walk people through that. Um, it's cleaner. It's much smoother for a rollover of a large retirement account into this type of annuity. Okay, so if I'm younger, I'm not looking at, 5, 6, 7 years when I'm thinking about retirement, especially if I'm very young. IULs are absolutely wonderful products. Just, tremendous product. Whereas an annuity is sort of like, I haven't made that shift from wealth creation to wealth preservation. I'm still squarely in wealth creation mode. Annuity isn't a good fit if that's where I am in my life, and those are my objectives. An IUL, I would say, is a great place for an allocation of some portion of my money. And um, if I'm older again, near that retirement phase of my life, an annuity is a great fit. An annuity is a great fit. An IUL can still be a good fit. And what's more attractive about an IUL than an annuity is I get to grow my money tax-free. In the annuity, whatever growth I make, I'm going to owe taxes on that. And if it's qualified money that I roll into my annuity, when I start taking that out, I still owe my taxes on that money because I never paid taxes in the first place. My IUL, I'm putting in after-tax money. Well, I always am, but I'm growing it up to 12%, up to 12.75%, 100% tax-free with no downside. So we set that up where we minimize the life insurance and we maximize how much of our money goes into the cash. And as we move forward in our lives, we are aware that I can reduce the life insurance in my plan further, so-called corridors, where I'm required to have a higher amount of life insurance in my IUL relative to how much of my money is going into the cash while I'm younger. But as I get older, the required the required life insurance portion relative to the cash declines. So I want to cut the life insurance when I'm able to do that in those outer years once I hit those thresholds. And by doing that, I'm reducing the internal costs of my IUL in order to further jumpstart my cash and maximize my returns. You can realistically be thinking in terms of 9, 10% average annual returns after tax in your IUL. Again, you really need to have somebody who knows what they're doing. And 97% of the IULs out there are not done that way. So I hope that answered your question, Brian. It's not just black and white. This is when you do an IUL, this is when you do an annuity. But for sure, as a general rule, older people nearing retirement, annuities, but IULs can still be a really good option. Younger people, it's really IUL.
Lee, do you have any questions? Obviously, you've been around the block here a little bit. What, just in general feedback from your end?
Not at this time. No. Um,
Another point, guys, that I want to make. So I spent 15 years as a Wall Street securities analyst, and I spent several years. I helped build up the assets in one of the first liquid alternative mutual funds. It was called Absolute Strategies Fund. And the pitch, the value proposition was alternatives defined as I get a lot of the upside when the risk assets stock market is strong. I get a lot of that upside. But when the big corrections happen, I'm playing structural defense. I'm not correlated to those downside, those big losses. That's the definition of an alternative. The best performing hedge funds in the world have 70, 80% of their money in alternatives. The Harvard endowment, the Yale endowment, 70, 80% into alternatives like private equity, venture capital, hedge funds. Here's the problem. They have access to the 0.1% highest performing companies in those alternative asset class spaces. Okay. They don't need daily liquidity, which you can't typically get from those types of assets. So this mutual fund alternative that some other guys created and I helped them raise capital. When the stock market dropped 60% in the financial crisis, that fund, that mutual fund, dropped 15%. In the next 18 months, the assets went to nearly $4 billion. Everyone's like, oh my God, this thing did exactly what they said it was going to do. It played structural defense when the market collapsed. I want some of that. Here's the problem. In the next 10 years, that fund, I think it was mid-single digits to low single digits. When the Fed's printing money, interest rates are zero, and the market's going crazy, low to mid-single digits isn't cutting it when the market's going up double digits every year. So all that money drained out. What's my point? It's extremely difficult to say we'll give you a meaningful portion when the stock market's strong, but we'll give you a small fraction when the market starts to collapse. It's extremely difficult to pull that off. It doesn't work. Either you cheat and I get all the upside, and then I get all the downside when that happens. And I learned the hard way. I didn't have the protection I thought I had. Or you do it legit, which is what that fund did. And only 15% of a 60% drop was absorbed, but they weren't getting anywhere near the kind of upside they needed. An IUL, a fixed equity indexed annuity, they do that for you contractually. I'm getting up to 9.25% in an annuity of the S&P 500's performance, but I don't absorb any of the drop, any of the declines. IUL, I get up to 12.75% of the S&P 500's growth, tax-free, and I absorb none of the declines. Now I'm paying for life insurance in an IUL too. So, don't forget that. We are minimizing that. But the cost benefit, the risk reward, you can get what I just said. There's hundreds of billions of dollars chasing that type of upside downside relationship. Institutional money, the smartest money out there, chasing that type of upside versus downside. Every single person on this call, you can get that performance contractually guaranteed by an A-rated carrier with these two products. That's why I'm very enthusiastic about them. Again, not for everybody, but they might be for you, and it's probably worth a conversation. You're muted, Brian.
Greg has a question. So Greg, go ahead and shoot.
First of all, thank you, Brian and Jay, for putting this on. I really appreciate it. I'm a fan of both IULs and FIAs. I have them myself, and I've sold them both. My question, Jay, is over the last year, I've had a bunch of annuity prospects that I cannot get off the dime, and it makes because they're worried about their liquidity, and the market's been high, right? And I've just struggled with that the last 6-7 months. I kind of wonder what I should be, what I'm doing, what I'm not doing right.
Well, first of all, we're trying to talk about these products as potential solutions for a challenging set of circumstances, right? I've got a market that I know is going to have to give way to a substantial correction. I don't know when it will happen. And there could be several years of upside that I don't want to miss all of while I'm waiting for that big correction to happen. So we're trying very hard on this call to make this educational for people. And we're not trying to sell anything to anybody. And your question is kind of about how do I sell, right?
Well, it's the liquidity. It's the liquidity factor. They want all their liquidity when, they should segment some and make it safe for all of the reasons you've talked about.
Yeah. So a growth annuity is for the portion of my investable assets that I absolutely don't need access to for the period of the annuity. And you can do as little as 25,000 in an annuity, just to be clear. I showed you an example, 500,000. So if I've got a big 401k But as we look at my cash flows and my circumstances, and we come to the conclusion that that's most of my liquidity, that's most of my investable assets, I probably can't put all of it into an annuity just on suitability grounds. But even if I can, what we're going to tell you is this is the percentage of that 401k that we think would be appropriate to go into this sort of a product. We're not going to put you in a situation where you need to be worried about liquidity. And by the way, that's step one, right? What if we still get it wrong? And there's some sort of a situation that comes into play in that person's life where it turns out we didn't keep enough money liquid. Well, I still have up to 10% that I can pull out of my annuity. And I can get a growth annuity where I pay for a rider that allows me to get a cumulative annuity, meaning if I don't take my 10% in 1 year, I can take 20% the next year. Now, there's some limits on how much I can, they won't let me go up to 100%. Well, that'd be 10 years anyway, but so I can take up to 20% in the second year. Now, I might have to pay 95 basis points, 90, almost 1% on my money. Now I've created a little bit of a headwind. It's not a hidden fee because I know that up front, but that's what I might have to pay to get a cumulative growth annuity, Greg, in which case well, I've really got a lot more cushion now if something like that did play out and I had some catastrophic expense that I wasn't anticipating. Well, I'm in the second year of my annuity and I can take up to 20% of what I put in out without any penalty.
Which carrier is that?
You could do that with Athene. We could do
Okay.
that with Security Benefit.
Okay.
Most of
Thank
them,
you.
most of them have that kind of a product. Again, it's a rider you got to pay for.
Mhm. Okay. Thank you.
You're welcome. Why don't we wrap it there,
Yeah.
Brian? Unless there are any other specific questions that are
No, somebody just made an emphasis about not liking taxes, but nothing we can do about that. So, otherwise, Jay, no, sincerely appreciate it. I did put in the chat. I've got those the previous, shows that we did basically. So that's all accessible. So you can go to the chat, and then once this is done, we'll get it uploaded, as well. But Jay, I really sincerely appreciate it. Really good insight. I've known you for a long time, and you continue to. I learn something every single day, so I definitely appreciate that.
Thanks, Mitch. Good.
Thank you.
Thank you all for joining.